Everybody, welcome back to another video here on Financial Friends. Today, we are going to be discussing why checking your stock portfolio is actually losing you money. Yes, that is the case. Now, before we get into the video, I do ask if you could just hit that like button down below. These videos do take a good chunk of time to put together. Your support greatly is appreciated. And also, go ahead and hit the subscribe button. That way you can join the friend group of 1,000 members strong. We're hoping to hit that by the end of the year. Without further ado, checking your portfolio is actually losing you money. So first things first, I went ahead and I pulled you on Twitter. I had some findings. I had to prove to you guys you do check your portfolios daily. Roughly 61 of you from Twitter and roughly 229 of you from public said you do check daily. That's 290 out of 366. So you guys are losing some money because of this. Not really. We're going to dive into the actual details and the behavior behind why that is possible. So behavior is important, and the book, The Psychology of Money, discusses that in depth. Now, I cannot give you specific financial recommendations, but I can give you a good book recommendation. That would be The Psychology of Money. Link will be down below. Now, Invest.com, invst.com, they did a blog post and they analyzed some studies and some other things, and they came to a couple of conclusions. I highlighted those important conclusions. It states that people actually dislike losing money more than they like making money. In a sense, they feel pain more deeply from a loss of money than the happiness of earning said money. And so investors will check their portfolios daily, like you guys, will actually be more at risk to take less risk. They will perceive investing as riskier and thus take less risk. So Betterment found some data saying that checking your portfolio quarterly rather than daily can actually reduce the chance that you see a more than 2% loss from 25% to 12%. And the conclusion that the 1997 study found was that the investors who got the most frequent feedback, aka the most information, aka checked their portfolios the most, actually took less risk, and so they made less money. So checking your portfolio could be losing you some money. Now, of course, I have here on the right side, there are always exceptions to the rule. If you're just seeing your number of your portfolio kind of in passing, maybe on a widget, or maybe you're just checking your account to make sure it's all there, checking your account to make a deposit, if you're seeing that number and you're not actually making changes, that's an exception, right? It's actually making these changes and actively taking less risk or making changes that can cause the losses. Now, it raises an important point of being active in your portfolio versus being passive, and I want to talk about that right now. Active versus passive investing. First off, what is it? You can see the objective up here in the top right. Being active means, whether it's a fund manager or yourself, you're attempting to beat the market return. You're trying to do better than the market. And the reason for that, and that we can come to that conclusion, is if you want to be a passive investor, you can very easily invest in something that tracks the S&P 500, and you will always get whatever the stock market does. The stock market does 100%, you'll get 100%. The stock market does 5%, you'll get 5. If the stock market loses 10, you'll lose 10 too. You can track the broad market with ETFs or index funds that exist. So the statement that NerdWallet came to is indexing wins most of the time. You could see the S&P 500 index down here outperformed an equity fund or an actively managed fund every single time over the course of a 30-year span. Whether that was over 1 year, 3 year, 5 year, 10, 20, or 30-year span, it always outperformed. And again, referring back to the top right-hand side of the screen, you could see that it cost more to underperform the market with an active fund, and it costs less to do better with a passive fund. So you could see where I'm starting to get with this, that checking your portfolio, making active changes because of risk tolerance or whatever it might be, can actually cause you to underperform, cost more, and just not make as much money. Now, passive versus active do have different use cases, and I highlighted some of the more important ones for the average investor. Things like flexibility, like can you hold specific stocks or bonds or not, aren't going to affect us as an individual investor. Hedging or risk management, while both useful tools, if we're trying to compound, build wealth long-term over time, aren't going to be something we're as worried about. But achieving low fees good tax efficiency, and tax management, which is an active use case, are all very important. And I want to focus mostly on the low fees because being active costs more and could be less tax efficient. So let's take a look at what it costs to be active. Now, here is a study. This is actually from the SEC. It's a portfolio value at $100,000 taken over 20 years with a 4% return. Now, that 4% return has a fee attached to it, either 0.25, 0.5, or 1%. And you could see, of course, the lower the fee, the better the return. The higher the fee, the less the return. And by the tune of either $10,000 or $30,000 less than that 0.25% fee. So if you're going to get 0.25%, that's going to be the fee. Instead of the 0.5%, you would be out $10,000. And if you got 1%, you'd be out $30,000. Now, you can also track the market with VOO or VTI. Now, this is not investment advice. It is just a fact. You could track the S&P or the broad market with VOO or VTI, respectively. Those are the ticker symbols for ETFs that Vanguard operates at a 0.03% expense ratio, which is much less than the 0.25. So if you took the market and got potentially a 4% return compounded annually, you would have a much better return with a lot less taken out in fees via Vanguard. And so I come to a few conclusions, what everything here boils down to. Checking your portfolio doesn't matter if you aren't going to make changes. If you check and you move about your day and you continue to invest in whatever way you invest, it's not going to affect it, the fact that you checked it. Now, a lot of us do check our portfolios daily, roughly 79% of us, and that could be harmful based on what we talked about with behaviors and the way that we think. And active management, so making those changes based on what we're thinking because we're checking every single day, could often cause us to underperform anyway. And being active, maybe using an active fund managed by somebody else, is going to cost you more anyways. So whether you're actively managing, which I personally would say I would be no better at actively managing a portfolio than any person who gets paid to do so, it's going to cost me more whether I use them or do it myself because I'll be less tax efficient. So the conclusion is checking your portfolio can cause you to make some mistakes. So take a look at active investing, take a look at passive investing, and decide what is best for you and your behavior style. Thank you very much for watching this video. I do appreciate all your support. Leave a like. It's free. There's no expense ratio. Also hit subscribe. Same thing applies there. There's no cost to you to hit that subscribe button. It does help the channel out greatly. Check me out on Twitter, Instagram, and TikTok, Instagram, and Twitter. I'm posting there daily. Thank you very much, and have a great day.